If you're making high 6 or 7 figures and you feel like Uncle Sam is your biggest partner, what if I told you that real estate isn't just about passive income? It's the greatest tax loophole, asset protector, and legacy builder. Welcome to the Wealth Planning Podcast with Brister Law, where we protect your assets, maximize your wealth. I'm Anthony Brister, attorney, financial strategist, and today we're talking about how high income earners can use real estate to not just build wealth, but keep more of it too. So let's talk about the problem. If you have a high income, you generally will have a high tax burden. And here's the truth. Earning more won't make you wealthy if your tax bill grows faster than your net worth. Most high income earners pay 37% in federal tax. They've got the FICA tax. Then you add in a 5 to 10% state tax depending on where you live, and you're barely keeping 50 cents on every dollar that you make. Let's talk maybe about a case study. Let's call him Mark. He was a surgeon. So Mark was making around $700,000 a year via 1099. His CPA just kept filing his taxes as if he was an employee. Didn't really care about if he was building wealth or not. He had no entities, no deductions, no depreciation. By the time he came to us, he was tired, feeling broke, and making big money, but not ever having anything to kind of show for it. In his first year after working with us and doing a tax strategy, he was able to save over 6 figures by just implementing a few simple strategies that no one ever talked to him about. So let's talk about why real estate is the #1 strategy for high income earners. Real estate isn't just about the appreciation, it's a tax game too. And here's why real estate wins. You've got depreciation, which is a paper loss that shelters rental income, and depending on material participation and other loopholes, it can offset some of your active income too. We've got cost segregation studies. Again, dependent on your situation, you can accelerate depreciation. It's like depreciation on steroids, essentially. You get a bigger deduction in that year that you get the cost seg, but make sure that it applies to your situation and you actually can benefit from it. And we got bonus depreciation. Again, you write off a big chunk in year 1. We've got 1031 exchanges, so you can grow wealth and then defer the taxes. We've got the short-term rental loophole. You can be a doctor by day, real estate professional by night. We've got the self-rental loophole too. So if your business is renting from someone else, you can be your own landlord and benefit greatly from the depreciation from it. So do you want to pay less in taxes without having to quit your job? Well, owning a short-term rental and learning about the short-term rental loophole beats the IRS at its own game. It's a great tool, especially for those just starting out. So next up, let's talk about the entity layer and how to structure it. I generally think that every piece of rental real estate should be in an entity, period. Right? You should have a revocable living trust, maybe a holding company or FLP, just depending on how many properties we have and your total net worth. But each property should be in an LLC in its own state. Whether you group those or not depends on your risk tolerance, but we want to keep that out of our personal name. If real estate is in your personal name, that's just a lawsuit waiting to happen. LLCs don't just protect you. They also can help with some of these tax strategies. Now, just because you have an LLC doesn't mean that you're going to get any more deductions or not. Really, LLCs are for the asset protection. And any tax benefit that you would normally get In an LLC, generally you can get otherwise. Proper succession planning also is another big one, and this is how the wealthy build legacies. I see a lot of people wanting to be like the Rockefellers. Well, the Rockefellers didn't sell assets. They structured them to keep them in the family over long periods of time. And this is kind of what you need if you want to set up generational wealth. At first, you want a revocable living trust, and then maybe consider a family limited partnership. And then we go into dynasty trust or irrevocable trust. But you need to make sure that you don't overstructure. Make sure that you talk to a professional about your goals, your financial situation, especially surrounding control, net worth, and the administrative burden and costs that come up with having these structures in place, right? 99% of people will probably need a revocable living trust, but not everyone needs a family limited partnership, and especially not everyone needs an irrevocable trust. So don't get oversold on a structure, but if it makes sense, make sure that you are protecting yourself and you're in a situation that makes sense for you. So now let's talk about another case study. I had a couple who had 20 rentals come to me the other day. They had properties across 5 states. They were all in their personal name. So asset protection was a big concern, but also the estate planning. If something happened to them, they didn't want to have to go through probate in 5 different states. So we created a revocable living trust, a family management company to help with the management of the rentals, then also an FLP to hold the rentals. Now their kids can inherit control and not chaos and not have to go through probate in several different states. So it was going to make the administration a lot easier and also give them that asset protection while they're living. If you died tomorrow, would your real estate bless your kids or burden them, right? And that's something you need to be asking yourself. You're working hard doing all of this stuff, but if something happened and generational wealth is a concern, is all this stuff you're working hard for actually going to benefit the kids or be that burden to them, right? If it's disorganized, in a mess, and they have to go through probate and take several years, it's going to be a burden on them. So now let's talk about something a little bit more sexy. We've already talked about this a little bit. The next strategy is for those high W-2 and income earners, and it's a short-term rental loophole. You don't have to be a real estate professional to get massive tax deductions in real estate. And one of these strategies we can do is a short-term rental loophole. It can be treated differently from long-term rentals. You must materially participate, but you can materially participate without having to spend the 750 hours and more than anything else in real estate, unlike a real estate professional. Bonus depreciation applies, and this helps shelter your W-2 income if it's structured right. So here's an example. Let's call her Dr. A, and she bought a beach house. She short-term rented it out in Florida at the beginning of last year. She got that in service at the beginning of the year. She spent over 100 hours and more than anyone else managing the property and other tasks related to it. She had more than 3 stays, and the average guest stay was less than 7 days. Because of all of these factors, she was able to qualify for the short-term rental loophole, and this saved her over $90,000 in taxes when we coupled that with a cost segregation study. Short-term rentals are like cheat codes for high-income professionals. You buy the house, rent it, spend the appropriate time and materially participate, deduct it, and then boom, you get the deduction. So what is stopping you from taking advantage of the benefits of real estate? You don't need more information. What you need is a plan. Real estate without a strategy is just another job, or even worse. So let's talk about the action steps. First, you should go schedule a discovery call at bristertaxel.com. Ask for a comprehensive consult. There, we'll get you a custom wealth plan, implement and structure your assets with confidence. Or you can DM us on Instagram, STR, at Brister Law Firm, and we'll send you a free guide on how to shelter over $100,000 in taxes using real estate. So stop thinking like a high-paid employee and start thinking like an entrepreneur and a legacy builder. I've helped hundreds of earners, surgeons, tech founders, athletes go from overtaxed to overprepared, and you can be next. We want you to earn your money, then protect it, and be able to multiply it. And that's the way for Brister Law Firm. You've been listening to the Wealth Planning Podcast with Brister Law. I'm Anthony Brister. If this helped you, please do 3 things. Subscribe to this podcast, share this with a friend who's making over $350,000 a year, and then book a free strategy call with bristertaxel.com. We'll see you next time, and don't forget to always protect your assets and maximize your wealth.